and gentlemen, we are starting again, or I should say we're continuing. And I would like to invite, because I guess this person doesn't need introduction in this community, I'd like to invite one and only Dave McClure. Dave, we know you're here. So Dave, basically the person who initiated all this, and his 500 startups and the Geeks on the Plane. That's why we're all here today. And we're honored that Dave is a relatively frequent guest in Russia, and especially DigitalOctober. And today, I guess, probably mostly for Russian entrepreneurs and investors, but I'm sure that Dave's own geeks also be listening and maybe asking questions. Today's keynote by Dave McClure. Welcome.
Great. Thank you. So I'm going to try and do this talk in about 20, 30 minutes. Usually it's supposed to be a 45-minute talk. Okay, thank you. If you guys are not too busy drinking or talking, you're welcome to ask questions, and I might even answer some of them. So what I figured I would talk about a little bit is kind of what's happening in Silicon Valley, both at the venture capital area and also with incubators and accelerators. The main point I kind of want to make, how many people know Mark Andreessen Horowitz? So he wrote a post called Software Eats the World, which was like why actually the rest of the innovation opportunity is still in front of us, and how technology and software are really taking over a bunch of other industries. In this case, I'm going to talk about why I think software is eating venture capital, and particularly why I think actually venture capital to date has been a pretty terrible industry and business in terms of performance, and hopefully why that might get a little bit better in the next few years. These slides are online if you want to look at them, and I apologize. I'm going to swear a lot. That might make this more interesting or entertaining. I'll talk a little bit about what 500 Startups is. Anybody heard of AngelList before? Yeah, so you all better fucking know about AngelList if you want any of your goddamn startups in Russia to ever get funded, because that's the way that US investors are going to learn about them. You might get investors here too. I'll talk a little bit about why I think we can make venture capital work better. That part actually I think is pretty easy. Well, a lot of people are still going to fail, but I think the ways that we can make venture capital better are very obvious and apparent. Making incubators work better is a little bit harder, and I'll talk a little bit about that. And then maybe we'll talk about scaling VC and going international. Sorry for those of you who can't read the bottom of my slides. Okay, I don't have a mustache, but that was like the post that I could get closest to Burt Reynolds, so I used that one anyway. I started out as an engineer about 20 years ago, actually probably a little bit more than that. First software development I think I probably did as I wrote some payroll reports for my mom's company about 30 years ago. So anyway, I was an okay engineer. I was kind of a shitty entrepreneur. I eventually became a marketer at PayPal and a few other places. Then I started getting into investing, and I found out all the other things I was incompetent at had prepared me really well for being an investor. So actually, I spent a few years doing personal angel investing, starting around 2004 when I left PayPal. Then I started paying attention and actually doing that professionally in 2008-09 at Founders Fund, and then more recently at 500 Startups. Along the way, I got the very good fortune to invest in a couple of companies. SlideShare, Mint, Twilio, and Wildfire are among them. Oh, okay, great. That's a good idea. And even though I've made a lot of fuck-ups, Wildfire was recently acquired by Google for about $350 million. SlideShare was acquired by Wildfire by Google. SlideShare was acquired by LinkedIn for about $120 million. And Mint.com was acquired 2009, I think, for $170 million. Twilio is still private, but they're doing very well. Those are 4 companies out of the 300 or 400 that I've invested in, but I've probably had a lot of other fuck-ups. So what is 500 startups? Well, I'm a liar. We're not really 500 startups yet. We're only 375 companies. That's been in the last 2 years. We will definitely invest in more than 500 companies, and we aren't planning on changing the name. So that's a brand, not a goal. We run a venture capital fund and also an accelerator program in Silicon Valley. We have an office about 10,000 square feet. At any given time, you'll see probably 30 companies, maybe 100 people there. Recently, we also brought in a group in Mexico that's running an accelerator program down there. But we have partners who are investing in Brazil, in Mexico, in India. We've done investments in over 20 countries around the world. We haven't done one in Russia just yet, but maybe we'll fix that soon. And we have a large family of founders and mentors, probably over 700 actually in total all over the world also. So a very large network of companies, and I'll tell you more about why I think a large portfolio is required. Anyway, so we do a lot of investments. Most of those are small investments, usually 50 to 100,000. Most things are going to fail. Most things are going to fail. If we're lucky, maybe 5% of our portfolio does 20x or better, and maybe another 20% of portfolio does 5x or better. And if we do that right, then hopefully we make money. I think I mentioned this before. AngelList is really, 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 really fucking important. So if you ignore everything else that I say, get to know AngelList. That's a picture of Naval Ravikant. He's probably one of the smartest motherfuckers in the Valley. He is changing the face of venture capital. As much as Paul Graham and Y Combinator has made impact and change over the last 5 years or so, 7 years, Naval has made amazing changes over the last 2 years. And so either AngelList or something like AngelList will probably be relevant for Russia and for many people around the world. It's not just for angel investors, it's also for venture capitalists, it's not just for the US. And also, it's not just a matching service for startups investors, it's also a platform. So we actually use AngelList to suck in data about both companies we haven't invested in, ones we have, entrepreneurs, other venture capital firms. It's really a platform and an API for us to get access to data and to add data to that. And there's a lot of interesting activity and metrics there that are useful for evaluating companies, both before and after you invest in them. Can someone get me some water before I finish this talk? Starting to lose myself here. So venture capital generally sucks. Like historically has sucked balls across the board. 2 out of 4 venture capitalists lose money completely. Maybe another 1 out of 4 make some money, but don't beat the risk-adjusted returns of other much more liquid security asset classes. Thank you, Sheila. And probably not even 1 out of 4 actually make money and beat the averages. Now, 1 out of 10 make a shitload of money. However, we're not really sure whether that 1 out of 10 can do it consistently. So the same 1 out of 10 this year that actually beats the average may not beat it the next 10 years. And by the way, it takes about 10 years for most venture capital funds to actually exit. So you put your money in, you wait 7 to 10 years, some cases 12 to 14 years before you see whether you're going to make any money. Most times you don't make money. And most times you do make money, you're not sure why. So doesn't that sound like a great investment? Hey, did I tell you I was raising a fund? So why is that? Well, the reason is because, oops, sorry. Generally speaking, most venture capitalists have no fucking clue what they're doing. And that's probably always going to be the case because we're investing in new technologies, investing in new areas, and so we really have to try and guess whether the person we're investing in knows the business more than we do. But the one thing that I think has been missed by a lot of folks in venture capital is some process to what's going on that actually can be standardized and scaled. And so most VCs, in my opinion, really are guilty of not taking their own advice. So VCs generally advise startups, hey, you want to scale, you want to figure out your process, listen to your customer, and start trying to scale that up. And yet we, venture capitalists, don't do that. You know, where's the Google of VC? Well, you could say it's Google Ventures, but they're not quite there yet. Probably the closest thing to, you know, really scalable process in venture capital is Y Combinator, or maybe AngelList, and, you know, hopefully us and a few other people. There's a presentation called Moneyball for Startups that my partner Paul Singh has put together that's also on SlideShare, and it really talks about making a real more quantitative process out of investing. And the basic story, this may be below the scene here, that we advocate is really to make lots of little bets, assume that most of them will fail, and then this is count cards, and what that really means is just monitor progress and stats, and then the stuff that doesn't fail, double down. Right? Now that doesn't mean that you're going to actually win, it just might mean that you'd have a shot at winning. Right? And so what we think is that probably there are smart people who can build businesses that can scale, right? And you don't want to make big bets early on these people because you can't really tell whether they're doing well or not until maybe 6 to 18 months into that process. And then after you've sort of made those initial bets and seen whether there's some progress, then you want to sort of double down on the things that are working. And that might only be 10 to 20% of the overall initial bets that you're making. But hopefully, because you made those earlier bets, you have the option to then double down on those. If you didn't make those early bets, you might not ever get into the round after it's working. So what we say is that we are pre-traction investors, but we're post-traction investors after we see that it's working. And that's different from most venture capitalists. Even though most of them say they're early stage, most of them are waiting for traction before they put money in. And then usually they're paying up to kind of get traction or trying to work some other angle to get into that deal through either their brand or their reputation or other perhaps reasons. Now, you can't read all of this, but basically, there's lots of reasons that VCs fail. One of those reasons is because they are arrogant about their own ability to pick winners. And if you look at the historical returns for venture capital, there's no reason that they should be arrogant. Usually it's just because they actually have a lot of money in their pocket and they tend to be arrogant. But the few things that we think really matter is really, you know, creating a community and some resources of support. Now, some people may say just building a brand is essential. So I do think there are really smart people out there and people who have built very big brands over the last 20 years or so. Sequoia Capital is probably one of them, Benchmark Capital, Greylock. Some other folks like Andreessen Horowitz have come into the market extremely quickly and built a brand in the last 2 years, have even returned 2x the initial capital in just 2 or 3 years, which is fucking unheard of in venture capital, that people would actually return 2x the capital in just a couple of years. So they seem to be crushing it at a level that most other people are completely unable to. But here's the one thing I really say that most of is be early and contrarian or late and right. So being early and contrarian means doing something completely different than other people. You'll probably be wrong, but if you're right enough, being early means you probably are paying a much lower price. And if you're right enough and you can double down on those things, then you'll hopefully be able to make money. The other strategy, which is more a traditional strategy, is to be late and right. By late, I mean you bet after traction occurs, and then you hope that you can still get another 5 to 10x out of that traction. A typical traditional VC these days, traditional, let's say, $250 to $500 million fund, they're going to make about 30 investments, maybe 40 investments over 4 years. They're going to sit on board seats. Individual partners might make 1 or 2 investments a year. Out of those 30 or 40 investments, probably they'll get maybe 3 to 5 big wins if they're really lucky. And let's do the math here. Now, venture capital aims to make about a 3x return over a 10-year period. So if they're investing, let's say, a $500 million fund, they want to make $1.5 billion. They actually probably own only 20% or less at exit, when the companies exit. So then they need 5x that in sort of exit value. So they need to make $7.5 billion in exit value on $500 million in investments. And they probably get that out of 3 to 5 companies, maybe really only out of 1 or 0 companies. So what we're saying as a venture capitalist, traditional market, is I'm going to make 30 bets over 4 years, and one of those is going to be a multi-billion-dollar outcome, and probably I need more than one multi-billion-dollar outcome to be successful. So a friend of mine who I used to work with at PayPal, Roelof Botha, one of the smartest guys you'll ever meet. Took a company public before he was 30. His grandfather was Prime Minister of South Africa. This storied history, really smart dude. His first investment at Sequoia Capital, youngest partner at Sequoia Capital, his first investment is YouTube. Fucking awesome, right? You know, $1.5 billion exit. And I'm like, Roelof, man, your life is set. Your very first investment at Sequoia is YouTube. You're like, life is great. And he's like, nope, still gotta work my ass off. You know, what have you done for me lately? You know, I started like understanding what his world was, and he was like, okay, with a $1.5 billion outcome, he was 20% of the way there for that fund. Right, so they still needed 4 more YouTubes. So in a typical $500 million traditional Silicon Valley fund, you need 5 YouTubes before you're actually returning getting a reasonable return that would offset some other stupid, much more stupid asset class. These days, those aren't performing so great either. But that's kind of phenomenal. Now, if you got a Facebook, or maybe even a Twitter, then great, you only need 1 of those. But how many times are you going to get a Facebook or even a Twitter? And are you going to be able to pick 5 YouTubes out of 30 investments? Like, that's fucking hard. That's really fucking hard, right? So, you know, let's take one of our sort of funds. So we're running, our first fund was about $29 million, right? We're making relatively small investments, but we're making a lot of them. We're doing about 250 investments right now per fund. So our goal is basically to find 10 companies out of those 200 or so that might be $100 million outcomes. So the companies I was mentioning before, SlideShare, Mint.com, those are sort of our target sort of returns. Maybe we get a Wildfire, which was a $350 million outcome every once in a while. And we're going to get a lot of smaller exits, companies that are maybe between 10 to 50 million, right, which are still decent wins, actually, for both the founders, for investors, certainly for the acquirers. Those could be really meaningful companies. They could be generating, you know, tens of millions of dollars in revenue, possibly. But they're going to be more frequent, a lot more frequent. So if we're lucky, we might be able to invest in maybe 30 or 40 of those out of that overall 200, 250 companies. Now, that's still hard. But at least it's sort of rational to think, okay, maybe we'll get 5% of our portfolio might be $100 million outcomes, and maybe 20% of our portfolio might be 25 to $50 million outcomes. But again, I have to be early and contrarian or late and right. The last point on here, which you may not be able to see, is basically says, worry a shit ton about valuation. Valuation matters. So if you have that $50 million outcome, right, and you invested at a $10 million valuation, that's only a 5x outcome, which sounds great until you realize that, again, you probably made 10 other investments that didn't return anything, right? And so if I have a 5x outcome, but I made 10 other investments that didn't return anything, now all of a sudden I'm making, you know, 50 cents back on the dollar. If I made that investment at a $2 million valuation and I get a 50x return, now I've got a 25x return. And so maybe if I made 10 other investments of the same size, now maybe I've made a 2.5x return. And depending on the time frame and depending on my ability to double down on that, I might actually make enough money. So here's kind of like what our process looks like when we're investing. And this is, we're not looking for home runs, we're just looking for wins. Right? And we sort of like do a lot of analogies between venture capital investing and baseball. Which is probably not correct because actually really good hitters in baseball are, get a hit maybe 25 to 30% of the time, and most VCs aren't actually that good. But let's think about it in that way, in that there's been a recent revolution, maybe over the last 10 years or so in baseball, where people previously were optimizing for famous names and very visible home run hitters. With the introduction of sabermetrics and this guy named, Bill, forgetting his last name, Bill James, thank you, who wrote a book about applying metrics to the business, to baseball in general, and then several people, particularly the Oakland A's and Billy Beane, started putting that into practice, and then other people in the industry. Now, most everyone is really counting other statistics than just home runs. They're looking at some combination of bases and at-bats and other things, that really applying metrics more rationally to how you select for winners and how you look at wins. And so we've tried to kind of come up with a similar philosophy with how we think about investing in startups, particularly consumer internet startups. Most of that is risk reduction. Doesn't mean we're going to be right, it just means we have a chance of being successful. And what we like to look at is understanding that the business that is being solved for, or the business is being addressed, solves a problem for a customer. Now, why do we go after that? Because what we want to know is that there actually is a customer out there that we can test for who might actually use that product and pay for it. And that might happen way before we actually solve the problem. So theoretically, we think about something that might be, let's say, a marketplace for finding a nanny for your kids. Right, now that's obviously something that matters to a lot of people. A lot of moms have busy lives. They may be working. A lot of parents generally may need help with their kids. And so if you could find a nanny who's reliable, at a reasonable price, you'd probably pay money for that. Now, I don't have to actually see that you can build that product to know that that business model is rational, right? So I'm not betting on both your ability to produce that product and whether or not to find out a business model. I know that there's a business model. So now let's also say that I want to invest after you've got a functional prototype. Now that doesn't mean I know that that functional prototype will scale, doesn't mean that I know whether you'll be able to make money, it just means that I know you've been able to produce a product. Now historically speaking, as both an engineer and a marketer, there's lots of risk points to startups. One of the biggest risk points is that you can get a fucking product out the door. Now that's whether or not you're technically sophisticated or not. If you're not technically sophisticated, big challenges in getting a product out the door. So we don't fund ideas, generally speaking, and we don't fund teams that don't have at least one technical founder, ideally more than one. So we want to know that you've got a functional prototype and you've got engineering talent on the team. That's one big de-risking of that business prospect. There's many other parts to de-risking that. Knowing that you have a business model, or at least some way to sort of like get a rational opportunity to get money from that customer. Whether or not you're making revenue right now, again, is a de-risking opportunity to that situation. Capital efficiency in building that business. So most things that we invest in are software ideas. Occasionally we've started to do some other things that are maybe capital intensive on combining software with hardware, but generally speaking we stay away from hardware, we stay away from other CapEx intensive parts of the business. These days there's a lot of things that you can build for very small amounts of money. Contrary to 10 years ago, whenever you were paying a lot for licensed software from database providers, paying a lot of money maybe for server software from Sun or other people, and paying a lot for the pipe or the internet connection. Nowadays, most of your cost, at least in the early stages of business, is just for headcount. It's just for people building stuff. The other significant expense is for customer acquisition. Now, you may still be spending money on customer acquisition even today, but you're probably spending less money. You're probably able to tell more about whether you're getting customers or not. And you have these massive distribution channels that exist now in search, social, and mobile platforms. So in the US, it's probably Google for search. It's probably Facebook and Twitter for social. It's probably Apple and Android for mobile. Maybe it's YouTube for video. And then it starts to drop off considerably after that, right? There are other platforms that are now coming out. But those 5 or 6 major platforms that are hundreds of million users, in some cases billions of users globally, they provide incredible reach, right? So now acquiring customers, it may still require money, but I can get to lots of customers on those platforms that I could never get to before. So for a specific class of investing, which we'll call consumer internet investing or mobile or maybe even small business that's web hosted, we can get to lots and lots of companies for customers, excuse me, for very, very small amounts of capital. What does that do? It gives us lots of chances to have experiments at failure, and hopefully a few of those will succeed. So now if we emphasize internet-based distribution models on search and social and mobile and maybe a few other areas like video and local in the future, if we have simple revenue models, for us that usually means e-commerce or transaction models, subscription or recurring models, maybe affiliate or lead gen models. If we have a functional prototype before we invest, you have built something that works that at least one person who's not your mom uses and maybe even pays for. Right? So now we've de-risked at least that someone cares enough to fucking use it, and maybe they'll even give you some money. We still haven't de-risked that you have to grow that business. We still haven't de-risked whether you're going to make money more than you actually spend in acquiring that customer. But we know we've got some small and measurable amount of usage. We might even have some money. And we have this small but cross-functional team, hopefully not just engineering, but also design and maybe in marketing, or at least something that feels like marketing to acquire customers. So if we're doing these things, we've de-risked quite a bit of our overall business model. You know, what's the primary risk that's left? Really, it's team dynamics, understanding that teams can actually function, which is very hard. We're all human beings. We're irrational. We're crazy. We get pissed at each other. We don't do shit. We're lazy. We don't wake up in the morning. We get addicted to all kinds of things, including the internet. And we don't get shit done very often, unless it involves us getting laid or getting paid or getting some, you know, sex or resource or other things, which is kind of rational. So there's still all these risks in the model. The number one thing is really that they get customers, right? That's the biggest risk, is that you have a product. Most people think, hey, if I can find engineers, I'm going to be successful. That's not true. Actually, engineers are plentiful these days, except, you know, they're competitive to get. And the problems we're solving are simpler. So building software-based solutions, actually there's all sorts of plumbing and infrastructure now that didn't used to exist. Other big thing that's still out there is monetization generally sucks. Particularly in developing markets, it really sucks bad. So monetization is still a big risk. In the next 5 to 10 years, that will get solved. Even in developing economies, monetization is now starting to happen. In another 5 to 10 years, it's going to get much, much better. Right? But distribution, customer acquisition is still a big risk, and also making sure that you can make money, right? That I'm paying $1 for a customer that I make, you know, $1.02 for later, and what's the timing on that, right? So it may be that maybe I make $1.02 right away on a customer that cost me $1. That's great. I've arbitraged 2 cents immediately over no time frame. Maybe it's like I make $1.50 6 months later off a customer that makes $1. Now, do you want to run a business that costs you $1 to acquire and makes $1.50 6 months later? I don't know. Do any of you want to do that? Yes? No? It depends. It fucking depends. It depends on whether you have capital to actually grow and sustain that business over time. Like, if you don't have the $1 to buy the customer, then no, you don't want to run that fucking business because you owe somebody $1 and they'll bust your knees. But if you have capital and you can finance it, and the cost of financing that money is less than 50 cents in 6 months, then yes, you do want to fucking do that, right? So there's lots of dependencies in understanding financial transaction structure, lots of dependencies in understanding how you scale the team, lots of dependencies in understanding how you figure out and scale customers. All of those are still risks that you, as an investor or an entrepreneur, have to figure out. But we've maybe taken out a lot of this other risk. Okay, let's move on. You guys get that? Does that sound rational? Is this obvious? Like, this is fucking obvious, right? Nothing was new here that I talked about. But most people don't do this shit. Okay, so now let's think about how we do this. When we meet someone, when I meet one of you here today, a bunch of you have come up and pitched me today, what's going through my head? I literally get pitched probably about 20 times a day, via email way more than 20 times a day, but I don't actually read my fucking email. But I will hear pitches from people probably anywhere from 5 to 20 times a day, sometimes a lot more than that, right? And after a while, you start to try and figure out, what the fuck is my process for doing this? So first thing is, you might be crazy, you might be a liar, you might be a crook. And that's hard for me to tell when I first meet you. I don't really know. I have no fucking idea. In fact, in many cases, understanding a great entrepreneur from a crazy lie fucking crook is really hard. Sometimes they're the same fucking thing. So crazy is actually good signal sometime. And then lying crook, well, there's ethics issues, but sometimes that's also a good signal, right? So that one's kind of hard, right? So here's the thing is the model that we actually use is that we want to see long-term sort of visibility into who you are as an entrepreneur and what your work style is. And actually, when you hire people, we also like to see that. So we want people to sort of come from some way to detect what's going on. How do we do that? We build a large network of mentors and founders, and we mostly take referrals from them. Most of the time, we want to know, when you come up and pitch me in 30 seconds, it's a fucking waste of time, usually, because if I don't know you, I'm hardly ever going to invest in you. And if I do know someone who knows you, then I probably already heard about you, and I'll probably invest anyway, regardless of what the fuck you pitch me about. Right? And remember, we're pre-traction investors, so usually you don't have enough stats to actually tell me that you're working. And if you do have enough stats to tell me that you're working, people have already probably invested at a price that's higher than I want to pay. Right? Interestingly, today I met with an entrepreneur that had interesting stats, and this is why we go international, is because there's other risk factors, and so there may be a depressed market for your startup internationally relative to the Valley, or maybe you want to come to the Valley. So there are interesting opportunities for us to go international and arbitrage kind of local financial capital excess or the laziness of Valley VCs. So, but let's suppose that we have some data on you from other people that we know. Right? Either some other people in the network say, hey, these people are not lying crooks, or they look interesting, or I've worked with this person before, they're smart as shit, or this person's really great at viral customer acquisition, this is an amazing designer, whatever. We've got a network of about probably literally close to 1,000 people, certainly more than 500 people who can help tell us that all over the fucking world. Right? Product, does it work, right? Crappy, not perfect. We just want to see functional use. Right? You can get something out the door. Market, are people using it? Probably not a lot of people. Again, if a lot of people are using it, price is going to be higher for us. So we want to see functional use, not their mom. Revenue, will people pay for it? We don't actually have to know that there is revenue. We just need to know that revenue is possible. Is there a rational revenue model that we can see in the future, or at least a customer with pain, where pain proxies for money? Right? If there's a customer with pain or a customer with strong desire, that proxies for future money, we hope. Growth. How will it scale? Do you understand what the customer acquisition channels are? Do they understand what they are? Are there competitive customer acquisition channels? Who's paying for that? What's the cost of it? Will that cost be greater or smaller than the revenue that's eventually generated? How much time does it take to generate that revenue? Finance costs. What does it cost to get a customer? Two things that I really want to understand from you before you have even built the fucking product is, what does it cost to get a customer? Do you have a general understanding of what it's going to take to get a customer from what variety of channels? And how and when do you make money? Do you make money right away? Do you make money later? Right? Like, that's the financing equation to understand. So if I can start to figure this out and do risk reduction in these areas, then I start to build a model for how I think about financing the company, how I think about whether I'm going to make a decision in you, investing in you. Hopefully I'm interesting for you. Hopefully I've demonstrated that I have some value to offer and that I'm not an asshole, so that I actually have an opportunity to invest in you. And here's the thing, this is this upfront due diligence, I think it's a complete fucking illusion. Most VCs think they are super goddamn brilliant. They know from talking to you whether you're going to be awesome or not. They know from 3 meetings whether you're going to be awesome or not. They hire some junior analyst to look at spreadsheets of data on you and figure out whether you're going to be awesome or not, and that's fucking bullshit. 99% of the time it's fucking bullshit, because they don't have enough data, and if they do have enough data, again, you're probably already too expensive to get in there. So it's we think, venture capitalists anyway, we think that 3 to 4 weeks of due diligence in understanding this product and somebody cranking through numbers is going to make a difference in understanding whether you're right or not. And that's fucking illusion. Because it probably takes 6 months to figure out whether you operate as a team in some level of sync or efficiency, or it takes us 6 months to understand whether you operate as a team or not. And then it probably takes 12 to 18 months to see whether your incremental efforts at getting a product out the door scale and start to get traction, and then you can actually make money at that. It may take 3 years to figure out whether you can make money at that. Okay? But you probably can't figure out winners right away. You might be able to figure out losers and screen out losers, maybe. But in my opinion, you actually want to have a loose filter here. You don't want to be too tight on investing in people. I can't tell you the number of companies I've fucked up by not investing in them. Airbnb, huge fucking company. These guys, 4 years ago, it was about 4 years ago, Obama was running for office, and the guys were at a party I was at, and Airbnb stands for bed and breakfast, the breakfast part. They were worried about whether the people that they got as, people renting out their rooms could actually make breakfast. Right? They thought, oh, that's a deficiency in our model. We need to make sure they get them breakfast. So they were creating cereal boxes to fucking send to the people so that they would be able to feed them breakfast. Right? They carried around these 2 boxes of cereal, one called Obama O's, another one called Captain McCain, right? And that was their pitch. They were walking around with these 2 boxes of fucking cereal, and I looked at them like, you guys are insane. you guys are fucking insane. I'm not going to invest in you. You got a couple boxes of cereal running around. You're fucking idiots. Turns out I was the fucking idiot. Those guys were awesome. They've got billions of dollars. They're a billion-dollar company probably making right now at least tens of millions, maybe hundreds of millions of dollars revenue. I was a fucking idiot. I did not have enough data to say that they were fucking idiots. I was wrong. And you know what? 100 other VCs in the Valley were also wrong. Fred Wilson was wrong. A bunch of fucking people were wrong. Now, some of those guys got in late and later. Most people were wrong. Most people were fucking wrong. One or two businesses in, I knew I was right early, or maybe I think I knew I was right, and maybe I was just lucky. Aaron Patzer, founder of Mint. Jeff Lawson, founder of Twilio. Even Victoria Ransom, like they created a $350 million company in 4 years. I had no fucking idea whether it was going to be a $350 million company. So the things that I think you can talk about, trusted referrals are probably much better than due diligence. I've worked with that person, they're awesome. I've worked with that person, they're a lying sack of shit. Now sometimes they could even be a lying sack of shit and still be successful. So you should maybe even discount some of that. Functional prototype, much better than team. Everybody says team is super important. That's true. Your ability to detect whether they are awesome is shit. You cannot tell whether they're awesome or not, generally speaking. Whether they've built a functional prototype, yes, you can test whether that is a functional prototype, whether people use it or not, whether people pay. Those are actually objectifiable, verifiable facts. You still may not be able to prove that it scales, but you know that product works as intended. This person uses it. They paid money for it. Customers and revenue, more than market. Is the market big? Is this a big enough market for me to invest in? I have no fucking idea. The thing is, there are billions of people on the internet. Turns out a 1 million user market is interesting if they pay you $5 a month. If you have 1 million users paying you $5 a month, you got a $60 million a year fucking business. Did I do the math right? Yes. Right? Now, if you make money on that $60 million a year business, you may have a $1 billion business. Great, I don't need fucking billions of users. I need 1 million users. Is the market big enough? I don't fucking know. Generally speaking. Maybe I might know from unit economics. Unit economics, interesting. This person might pay me. Here's a real example. TenderTree, company we're investors in. What do? They provide a marketplace for senior caregivers. Do you have a parent or a grandparent who can't take care of themselves, needs an attendant? How many people have a family member that in the next 10 years might need help growing old? Probably every one of you in the fucking room is going to raise your hand. How much would you pay for that? Thousands of fucking dollars a month. That customer is likely worth thousands of dollars, maybe $10,000 to you. How many of those customers do I actually need to have a real business? Probably like hundreds. That's it. Maybe 1,000. Right? So 1,000 customers in that business is $1 million a year business. Depends on how big a business you want to build. So that business, hugely valuable on a relatively small amount of customers. Now, do I know how big the market is? Do I know if that person can grow the market? No, I don't. So you'll be wrong 4 times out of 5 with all this shit. You'll just be wrong. You'll be wrong both sides. You'll miss big opportunities. You'll invest in shit. Both of those will be wrong. If you don't suck, in 6 months, you might know whether you're right. You might know whether they don't suck at least, right? So in 6 months, something went right? Either more users, more usage, more revenue. In 6 months, you have a verifiable, objective perspective on due diligence that you were correct. They did not fuck this up. They did not scream at each other and quit. They did not run out of money. Somebody else funded them. They did not fail to get more customers. I have more users than I did 6 months ago. There are objectifiable, verifiable, external facts that you can see in 6 to 12 months that tell you whether they don't suck. Still doesn't mean they're awesome, just means they don't suck. At that point, what do? Double down, right. I invest a little bit more money. And depending on whether I have visibility into how well they're doing, I might invest a lot more money, but I invest a little bit more money. Also, valuation is important, right? So if the price went from 2 million to 20 million, maybe I don't invest money even if they're fucking awesome, right? Because I might get bought for 50 million, at 20 million I only get a 2.5x return. Maybe that's not a good enough return relative to my other failures in the market. In 1 to 2 years, you might know if they're awesome. If they keep continuing to make 6-month incremental progress in users, in usage, in revenue, in customer acquisition conversion costs, in something else, if they are able to hire and scale and grow great people and they don't fuck up and they don't fall off a cliff, right? And you make continually incremental bets, then you might actually make some money and you might find out they're a big fucking win and just keep scaling, right? And if you're lucky you had your earlier positions, you can protect those earlier positions. So upfront diligence, fucking illusion. Only thing that you can really objectively verify is incremental progress, and you still have an issue to understand around valuation relative to that incremental progress. Not sure what the time check is here. Anybody know? Do I got time? Is this interesting shit or is this boring? Okay. All right. Interesting shit. Good. All right. This is my usual crazy-ass fucking slide. So the thing that is starting to change, at least for early stage investment, is entrepreneurs are starting to understand they have power to some extent, if they're good, and that things other than money matter. Either it's the case that only money matters, they know what they're fucking doing and they just want your money and get the fuck away, right? Or it's like, hey, there's something other than money that matters. What would that be to me? It might be a lot of things. It might be you smell nice, you look good, I like to hang out with you, I like to get drunk with you. It might be that, hey, you offer expertise in product, in marketing, in engineering, in design. It might be, hey, you have a bunch of other cool people that I like to hang out with. It might be that you know the press. It might be that you can get me introductions in another country or access to like more developers. I don't know what the fuck it is. But you have to have some resource. Either you have to be the best, cheapest capital available to them, right? Which probably doesn't help you as an investor if you're the cheapest capital available. That's a zero-sum game with them, the entrepreneur, right? Or you want to offer something else. So if you want to actually be a great investor, probably you don't want to offer cheapest capital at price, at least not forever. You might do that as an initial strategy to build brand and get customers, but eventually you need to actually do something else, which is either be trustworthy, be a nice person, or offer value. What is that value? In early stage startups, it's probably around product and marketing. In later stage startups, it's probably around recruiting and business development and access to capital, and maybe even access to exits. So if you look at kind of how the market is developing, companies like Andreessen Horowitz, their job, what's their job? To get you from 25 users and some amount of traction to shitloads of traction, 25 people in the company, to like 500 people in the company, right? They want to get you to like massive amounts of scale, right? So they want to leverage and arbitrage and optimize building you from a 20-person company, maybe $1 million in revenue, to a 500-person company, $50 million in revenue as fast as they fucking can. And if they're great at recruiting and business development, they have operational infrastructure to like redirect to all of that. You know, Rocket Internet, another like, you know, whether or not you like the ethics and the approach, Rocket Internet's really, really fucking awesome about taking a company and model and like immediately moving it to all parts of the world. Other side of the world is Y Combinator, right, which is Guild of Geeks. And what I wrote a blog post about this where I said like the real fundamental changes going on. One is that YC is trying to scale, right? They did 80 companies in their last batch. They're trying to do like over 150 companies a year. They're trying to scale up the process. So both Andreessen Horowitz and YC are scaling from different ends of the spectrum. AngelList is trying to scale also by adding software to the business. So what's going on is we're starting to see the same techniques that we actually practice in building software companies, in applying how we finance companies by software. We are practicing what we preach. Right, so Guild of Geeks, if you think about like all these software points of failure, like what's your like insurance against failing? It's learning from other people who've practiced this craft, learning from other people who understand how to do SEO and SEM and engineering and different stacks on top of like Ruby or Python or whatever, right? And trying to figure out like all these other visual design techniques and financing techniques and business development techniques. So I want to know other people with operational expertise, right? How do I do that? How do I get to know those people? Like, they're actually busy people. They don't necessarily know who the fuck I am. They don't want to give me their time and energy. So you start to like have this guild approach. And actually, with Y Combinator, they started to scale that. So now YC is invested in over 500 companies, right? Most VCs, in the lifetime of their entire firm, don't invest in 500 companies. In many cases, they don't necessarily want to like help do all this stuff. They want to scale people who've already had success. So the early stage process of product and marketing are probably a little bit different than the later stage process of scaling and recruiting. So in the early stages, you want lots of these engineering, marketing, and design types who've been successful before to help mentor the next generation. So it looks more like people learning a trade or a craft, right, and providing some incentive for them to do that. Where previously that might have been apprenticeship and giving them all the revenues. Now it might be equity, right? So the same people who are in YC from 3 batches ago are probably investing and mentoring the companies that are in this batch. So Guild of Geeks and mentors, pretty important. Not khakis, guys in khakis and blue shirts. All right, if I'm not too long on this, I'll talk a little bit about what accelerators are all about and how I think we make these better. So the other thing that you'd probably like to be able to take advantage of is watching other people fail or watching other people succeed. Right? I want to have this tribe where I can see lots of experiments going on and see both failure and success in quick physical proximity so I can learn from that and follow the success and not follow the failure. I want to have this community of mentors. I want to have a tribe that I trust. So we emphasize education probably as much as anything. We run physical conferences and events. We have mentors come in. We try and get our tribe to teach itself. Right? We focus on design, data, distribution. It's a little alliterative. The reasons are most founders that we focus on tend to be engineers. That means they're great at building product. It usually means they suck at design and UX, which is important, and they suck at marketing and customer acquisition, which is also important. And they might suck at metrics, although they shouldn't suck at that. That's more a philosophical kind of approach. Platform partners, we actually try and build relationships. We're in great position to do that because we're in Silicon Valley and we used to work with people at Google and PayPal and other places, so it's easy for us in Silicon Valley to establish those partnerships. But in Russia and China, they're different partners. The thing that's nice for us is the Silicon Valley partners tend to be relevant in most places around the world, except Russia and China. Sponsors and strategies, marketing, visibility. So we try and do all these things and put it in a physical environment. So one thing that's different about us than YC is we're trying to have physical proximity for all this stuff. And what I describe here is kind of this outlier competition where I want to model success behavior and give myself a chance to see that. So what happens is because we suck as investors or just because things tend to lay out somewhat randomly, some people will perform better than others. And let's just say that in most cases there might be 20% of our entrepreneurs who perform much better than the other 20%. Those people are going to be rock stars with or without us. They're going to succeed whether we give them money or not, etc. Then there's another group that might be another 20%, and they might succeed with help, but not without help, right? And it might be our help, it might be the other peers in the group, whatever. And then there's a bunch of other people who will fail regardless of whether we help them a lot or a little. They will fail anyway, and we don't want too many of those because that'll drag the group success down most likely. So what happens if you have a sample size of only 5 companies and 20% succeed? 1, right? That 1 will be at the top of the mountain. If I have 10, I might have 2 of those. If I have 20, I might have 3 to 5 of those. When I get to 20 and I have 3 to 5 of those rock stars or outperformers, they'll compete with each other. Right? I was teaching a class at Stanford about 5 years ago, and it was based around people building Facebook apps. At different parts during that semester, each of 5 different teams was the leader in terms of number of installs. They all eventually got to more than 1 million installs. That was a crazy fucking time, but they leapfrogged each other throughout that period. And they were all watching and learning from each other. They were competing to be the leader. The next group of people, there were 10 other people that built applications that had 100,000 user installs. Still an amazing number, but they were learning from watching the leaders, right? If they weren't around those leaders, they probably would never have won at all. So you build this and facilitate this environment where outliers who are really awesome compete against each other and learn from each other. And their visible behavior helps bring up the next group of people who would not succeed without that visible model of success in their face, right? And maybe you even have the other thing going on, which is visible models of failure in the space also help influence success outliers avoid those failures, right? And so this physical proximity is important. In YC, they're actually trying to scale people without the physical proximity. That may also work. I don't know. We're trying to do it with physical proximity because of these factors, right? So we sort of modeled around a tribe size of about 100 people, about 25 teams. In my opinion, 10 teams is not enough. Certainly less than 10 teams is not enough. More than probably 30 teams, which probably means more than 100 people, you'll start to lose physical proximity. You won't be able to see the models for behavior. Tribe size is just too large, north of 100 or 150, right? And so this is theoretically a model for building success in a competitive environment and then modeling that success behavior for other people to watch. I don't know whether this works or not, but this is what we're trying. Okay, product market revenue, this is generally staging it. We hope to come in after you've got functional product, but you'll still need to develop that product more. Market, we want to understand that you've got usage, and then we want to try and scale usage, and we want to scale usage in a way that generates more revenue than you actually cost to acquire the customers, or you can at least finance that gap during the early stages of the company. In the long term, you want to be able to optimize for either profitable revenue or growth in a way that drives out the rest of the market. So product market revenue, usually done in staging that's in that order. If you're an entrepreneur who doesn't have access to capital, you might need to do product revenue market first. You need to figure out how you make money before you actually scale the business. And then we also help them work on the pitch because we know they're going to need more money in most cases, and we want to have other people downstream help take on the next stage of development of that company. Hacker, hustler, hipster, or designer. We think these are the core skill sets, at least for consumer and small business internet services. So engineering, marketing, design, and really when I say design, I mean visual design and user experience. In fact, even visual design is not as important as user experience. Understanding how users use the product, whether or not you're a great designer, you could have a great designer and shitty UX and fail much worse than having a great UX person and a shitty designer. I can't prove that to you right now, but I believe that to be true. Jesse, who is a designer, is nodding his head. He agrees with me. So this order is basically build functional prototypes, improve the user experience so people convert. Hopefully they convert profitably to reasonably believable and actual measurable monetizable events, and then scale customer acquisition and distribution. And you might scale that profitably or unprofitably. It depends on your goals, right? If you're a lifestyle business, you might want to scale it profitably. If you're a venture finance business, you might want to scale it big and unprofitably first, and then later profitably, or maybe even unprofitably forever and get acquired. That's a little bit more dangerous game. We don't like to do that, but that has succeeded for many people. Winners, losers, tweeners. I said this before, and this is really a pessimistic view in the universe. Generally speaking, winners win with or without you. Losers lose with or without you. Tweeners tween with or without you, although even with you, they'll probably tween and it'll fucking suck up all your energy. Now, this is a really horrific way to look at the universe of entrepreneurs. And two things happen. One is they may learn and you may be wrong. So don't be a fucking asshole and assume that just because they're losers right now, or you think they're losers right now, that they're going to be losers forever. That might be true, but it might not be true. And if so, you're a stupid fucking asshole and you're going to miss the next Airbnb. So don't assume that they lose forever. However, the thing is, if they tween, it's going to suck up all of your fucking time. So from a completely transparent point of view, what do I want to do? My winners are going to win whether I spend time with them or not. My tweeners are going to tween whether I spend time with them or not. So I spend enough time to not be an asshole, and I facilitate time with other people in the network so it doesn't suck up my time. Hopefully they learn and eventually become winners. And the losers, I try and figure out if I can help them avoid losing behavior in the future, or at least not influence the rest of the tribe with their losing behavior in negative ways. That's an extremely transparent view of the universe. I'm just being very honest with you about how I do that. Now, what this also means is that I don't need to sit on board seats, generally speaking. Winners win with or without me, and if I spend a lot of time on board seats, it actually prevents me from doing my other job, which is making my model better or finding other awesome companies. So you want to find awesome companies. By the way, you don't know they're awesome right now. You'll know you're awesome 2 years later. And you want to avoid losers is really what we mean by that is don't fund things that aren't working. We're not trying to be assholes. We're just not going to double down on things that are obviously failing. We might put a little bit of money into things that we think could be working, or even if we think they're not working, we might put a little bit of money in just not to be assholes because they might learn in the future, and then in the future, you don't want to have to be that guy who was an asshole before. So again, we might actually put some more money into companies we know are not going to be working to not be an asshole. That's a questionable fiduciary responsibility unless I'm thinking for the long term, in which time I'm building a relationship with them if they're not going to fuck up the next time. They might win with your help, but they'll win without your help. They might lose with your help, but they'll lose probably without your help too. Be helpful and don't dally. Remember, you might be wrong, so don't be an asshole. Scaling VC, we've talked about this. It's a very immature and fragmented market. You think that VC's been around forever. You think VCs are perfect. You think VCs are masters of the universe. Maybe you think they're arrogant fucking assholes, but they act like they're masters of the universe. The reality is their industry is super fucking inefficient, doesn't scale, is full of idiots who have no domain expertise, and they operate wrong. They are assholes and idiots, and they think they're awesome. What a fucking bunch of losers. By the way, did I mention I'm a VC and I'm raising a fund? I could really use your help right now. It's ripe for disruption at massive ends of the market. The low end, the high end, the middle. We don't use software. We don't use automation. We don't scale. We don't have domain expertise. We don't have all this fucking crap, which would actually make us better. And the stupidest thing is we know this. It's because what we tell our entrepreneurs to do. Automate, scale, figure out your fucking business model. And yet we don't do it. We haven't been doing it for fucking 30 years. We are fucking idiots. And we don't even know we're fucking idiots. We're hypocritical fucking idiots. Jesus Christ. And our asset class sucks. It's been performing like a goddamn dog. Except for a few people who think that they can do it on a repeatable basis, and they have no proof that they can do it on a repeatable basis. They're B.F. Skinner's fucking pigeons hitting the goddamn thing and thinking that flapping their wings is what's giving them sugar water. Like, we're fucking idiots. We're shamans. We're shamans. We're shameless fucking shamans. We have no verifiable proof that our process works and is repeatable. Maybe Sequoia does. Maybe Excel does. I think Excel would even admit to you they were really fucking lucky in their most recent fund and got Facebook and Groupon and a bunch of other shit. 10 years ago, Excel was not doing as amazingly as they were doing right now. Sequoia's had their years that were in and out too. So, do you think VC is ripe for innovation? Hell fucking yes it is. 10 different ways we can make this shit better. 10 different ways we can make it better. All right, last point, going international. This should be relevant to the rest of you. Do you think, first of all, how many people are in the US? No. How many people? 300 million, roughly speaking. I've scared the shit out of you guys now, haven't I? How many English speakers around the world, native English speakers? About 1 billion. How many second language English speakers? Maybe another 1 billion. Still, 4 billion, 5 billion other people who don't speak English. 6.7 billion people or some such that don't live in the US. Why the fuck are we only looking at the US? Why the fuck are we only looking at English speakers? Again, scalable market, billions of devices. I can do translation automatically or through human intervention. Language is a big business, by the way. Einer fucking knows that. Language is a big business. So the world is my market, not English speakers, not the US, not country borders, not currency. There are reasons why currency and borders and other regulatory restrictions and even language, make a difference. But most things, eventually, you can get around, right? So how do we de-risk this? How do we go after large markets? Well, we look at large and growing markets that have growing internet and mobile penetration, hopefully smartphone penetration. And there are a few of those that are really interesting. So right now, we're working on Brazil, Mexico, and India. Probably looking at Canada and UK and Japan, although those actually already, Canada and UK speak different forms of English. Japan's in an interesting situation. Most people from a macro picture think Japan is done. They think, oh, the population there is aging, population growth is lowering, they have huge consumer government debt, and you know what? Japan is one of the most active internet populations in the world, highest GDP per spend, amazingly growing on an e-commerce basis, and culturally speaking, entrepreneurship not encouraged in Japan. Generally speaking, not much capital access in Japan. It's this huge fucking market that has very little internal competition. If you are willing to learn Japanese, partner with someone in Japan, it's an amazing market to go after. Really, I'm totally fucking kidding. China, on the other hand, big fucking market. You know how many people are going after China? everybody, the Chinese and everyone else, are going after China. It's an overheated market. There's way too many people investing in it. There's all sorts of questionable regulatory issues, questionable political risk. It is a big opportunity, so it's worth trying to figure out. But relatively speaking, Japan, so much easier than China. Anyway, sort of weird perspective, but like, you know, again, looking at valuation, like you may think this is an awesome company, and here's another less awesome company, but the valuation is huge for this one. Valuations are actually reasonable for this one. This one may be the better bet. Same sort of analysis in how you look at countries and markets. So Russia, 140 million people, probably another 50, maybe even 100 million speakers around the world. Also a lot of people in Russia who want to learn English, like lots of natural resources. So it's a big market, lots of talent. Monetization's maybe not great here, and hopefully that's getting better. Probably right now much more engineering talent than design talent and product management talent. But you've got one generation of entrepreneurs that have been successful in Russia. Hopefully they're starting to teach and invest in the next generation. Market opportunity looks pretty fucking good in Russia over the next 10 years. Plenty of technical resources. The ability for like former entrepreneurs to mentor next one's only going to get better. Capital availability starting to increase. So future's fucking bright. Time to buy sunglasses. Cheers. If you're not bored and want to start drinking, you can ask me questions and I'll try and answer a few of them. If not, we can move on.
I think it was so fucking awesome that we have to move on. But we promised to return Dave in half an hour, even less, to this very stage for a fireside chat about managing portfolio. And now I'm asking our next panel on venture capital.